Good afternoon. Can you all hear me? We're going to get started if folks can find their way to their seats. All right. Thanks, everybody, for your patience. We're just waiting for everybody to assemble, but I want to say good afternoon to everybody and welcome. Welcome to those of you who are here in person and welcome to those joining us online. I'm Chris Herbert. I'm the Managing Director of the Joint Center for Housing Studies, and it's my pleasure to welcome you today to the release of the State of the Nation's Housing 2025. We're enormously grateful to the Federal Reserve Bank of Boston for hosting us and to the 7 other banks in the Federal Reserve System for co-hosting today's event. Since it was first published in 1988, the goal of the State of the Nation's Housing Report has been to put a spotlight on housing market conditions and raise awareness of the importance of housing for the well-being of the nation's households and communities. A key goal of the report is to provide robust information to inform policy, advocacy, and industry as each work to meet the nation's critical need for good quality, affordable housing in thriving communities. An important goal of the release each year is, of course, to share the report's findings. But perhaps more important is to bring together stakeholders from these different sectors to discuss how the report can help inform and shape the actions needed by policymakers and leaders of both for-profit and nonprofit organizations to address the country's biggest housing challenges. We can think of no better place and no better partner than the Federal Reserve to help us raise up the report's findings and to host the discussion of these important issues. Shortly, you'll hear from my colleague, Dan McHugh, who leads the development of the report and will provide an overview of the headlines this year. Following Dan, we've assembled a panel of Boston area leaders representing the worlds of policy and practice to hear their perspective on the findings and how they inform their work, especially here in Boston in our high-cost market. We'll then hear from Eric Belsky, Director of the Division of Consumer and Community Affairs at the Federal Reserve Board of Governors. Eric is a leading national voice in housing policy, but more importantly, he has a long history of shepherding this very report when he was director of the Joint Center. He's also a close friend, so it's particularly special for us to have Eric with us here today. Following Eric, we have a panel of representatives from the Federal Reserve banks from across the country to zoom out from the Boston area and consider how housing conditions and the responses needed vary across the country. But first, it's my great pleasure to introduce Dr. Susan Collins, President and CEO of the Federal Reserve Bank of Boston, to welcome you and to provide her own introduction to today's discussions. Dr. Collins, thank you for being such a gracious host. The floor is yours.
Chris, thank you, and thank you also for your leadership and for the center's commitment over many years, as we've heard and we'll hear more, to understanding but also to addressing America's housing challenges. That matters, and I think that is why we have so many here today. So it's really just a pleasure to welcome all of you here to the Federal Reserve Bank of Boston. So those of you in the room, and I think we were expecting to have roughly 1,000 people tuning in online. And so thank you as well for joining us. Welcome. We're delighted that you're here. Again, I also want to thank the Joint Center for Housing Studies, as well as the 7 other Reserve banks who have joined us in co-hosting this afternoon's event. I'm also going to thank in advance all of the speakers that we're going to hear from today, including my colleague, as has already been mentioned, Eric Belsky, who's Director of the Federal Reserve Board's Division of Consumer and Community Affairs, and a former head of the Joint Center, as you've just heard. So particularly lovely to have him engaged in this work with us. So today, the Joint Center, as you know, will present its report, followed by an expert panel. I'm looking forward to that. We'll hear then from Eric Belsky, and then also from the panel of Federal Reserve leaders. My comments are going to touch on a number of issues that relate to housing data, housing affordability, and the importance of housing in the economy more broadly, and the Federal Reserve's engagement in housing issues, especially with the regional economy perspective. But first, as always, I'm going to note that the views I express today are my own and may not represent the views of my colleagues on the Board of Governors or at other Reserve banks. So it's really great to have such a multidisciplinary range of speakers and members of our audience for the conversations today about what is an issue that's not only complex, but it's really multidimensional as well. Housing challenges affect so much of our country, and of course that includes rural and urban and suburban areas, so all different types of areas and localities. And it also impacts people from across the income spectrum, and I'm not sure that that's always as fully recognized. Here in the room and online, we have housing practitioners, we have researchers, and we have policymakers. And I'll note that the participants from the Federal Reserve are also representing expertise from economic research, from community development, and from other functions as well. So I realize that some may be wondering about the Federal Reserve's interest and involvement in housing issues. So certainly the Fed's purview and focus is monetary policy. It's not fiscal policy, and it's not the intricacies of state and local government policies that affect housing in a wide variety of ways. But housing is deeply tied to the overarching role of the Federal Reserve, and that's supporting a strong, stable, and healthy economy and financial system for the benefit of the public that we at the Federal Reserve serve. So while the flow of new housing, in other words, residential investment, represents only about 4% of annual U.S. GDP on average, it can have an outsized effect on business cycles. So during the mid-2000s boom, for example, housing drove over 17% of GDP growth. And in the subsequent collapse and recession, residential investment accounted for 40% of the contraction in output. Housing also affects household consumption through wealth effects. It affects financial markets through mortgage securities, and it affects local government finances through property taxes and fees. And most importantly for monetary policy, the housing market is very sensitive to interest rate changes. And that makes it an important policy transmission channel. When the Federal Reserve adjusts interest rates, housing typically responds first. And it tends to spread the effects of monetary policy throughout the economy. Some of these effects have been evident in the current monetary policy cycle. In the housing market, higher interest rates have slowed new residential investment. Less housing activity, in turn, has contributed to the more moderate overall demand we're currently experiencing. And in the near term, the modestly restrictive stance of monetary policy, while necessary, limits the housing supply expansion that's needed to alleviate some of the pressures in the housing market. But ultimately, the goal of monetary policy is to restore price stability while maintaining healthy labor market conditions. And price stability is essential to foster sustained growth, a strong labor market, and an economy that works for everybody, including stable, predictable economic conditions that benefit the housing market over the medium to longer term. And beyond cyclical considerations, there are many long-standing issues and I would say pain points in the sector, and we're going to hear about a number of those today. In particular, as the State of the Nation's Housing 2025 report demonstrates, rapid price and rent increases over the past 5 years have created enormous pressures on household budgets and placed home ownership beyond the reach for many Americans. But this affordability crisis extends far beyond individual hardship. It constrains labor mobility. It limits the ability of businesses to hire. It affects where businesses choose to expand operations, and it reduces the wealth-building potential that home ownership has historically provided to American families. And these are just some of the reasons why it's so important to have a regular, in-depth look at housing, and in particular, that is what this report provides. So as a lifelong proponent of empirical analysis, and I will say a self-proclaimed data geek, I just want to spend a moment on the importance of data for understanding the challenges that relate to housing. The State of the Nation's Housing 2025 report distills extensive data sources into a comprehensive picture of the U.S. housing market, providing insights into current trends and emerging challenges. And producing a report of this depth and clarity really requires not just analytic expertise, but also a robust foundation of data. And that foundation comes in large part, I would say, from the national level statistical data infrastructure. So in particular, the Bureau of the Census provides essential surveys, the American Housing Survey, the American Community Survey, and the Housing Vacancy Survey that give us a representative view of the landscape. Additional federal data add to this picture, such as the U.S. Department of Housing and Urban Development assessments of homelessness, and the Bureau of Labor Statistics construction costs data, and there are others as well. This public data infrastructure is also crucial for understanding the rental housing market, where private data is often fragmented or incomplete. Unlike the for sale market, where centralized databases from real estate professionals and mortgage servicers provide comprehensive information, rental housing spans millions of landlords and property managers, and many of those are not asked to report data into any single system. So that's why federal government-supported surveys remain the only comprehensive lens into rental conditions, especially for low and moderate income households. The data illuminated by the report have really sharpened the picture of a housing landscape that's marked by growing affordability challenges. And some of the data included in this report are just really particularly striking, and I'll just highlight a couple of points. I know we're going to hear a number of others in the presentation. Home prices have surged 60% nationwide since 2019, pushing the median price for a single-family home to over $412,000 in 2024, and that's a record. This means that a price-to-income ratio is well above 3, which is the level traditionally seen as affordable. Monthly mortgage payments on a median-priced home have reached $2,750, requiring an annual income of over $126,000 to qualify as a borrower under standard lending ratios. And on the rental side, half of all renter households, and that's over 22 million of them, were cost burdened in 2023, which means that they spent more than 30% of their income on housing and utilities. And over 12 million households spent more than half of their income on rent. So as much as I, like many of you, love data, we also know that these figures are not just data points. They reflect economic realities, often painful realities for many families, and real strain on people, on communities, and on places. So while housing markets are tight across the country, the aggregate data also masks significant unevenness. Housing challenges vary dramatically, and we're going to hear more about that, across the United States. For example, we may see affordability challenges and supply constraints in cities, infrastructure shortages in rural areas, and zoning disputes in suburbs, or a mixture of all of these different challenges and others in a given area. So clearly the national housing crisis requires local as well as national understanding and solutions. The reserve banks gather and contribute regional insight and analysis on a number of topics, and those include housing prices, rent dynamics, construction activity, and that helps to deepen insights into how national economic forces play out locally. A number of our Fed economists do analytic work on housing and its role in the economy and the financial system. And in my role as a president of a regional reserve bank, I routinely connect with business and community leaders and with a wide range of stakeholders across the economy in the 6 New England states. And this gives me important insights into the barriers and the trade-offs and the economic realities that households and firms face every single day, including related to local housing conditions. And all of this I see as really essential and important part of policymaking in the public interest. I learned firsthand about how supply constraints, construction costs, zoning, access to credit, infrastructure, and affordability all play out in distinct ways to affect local housing markets and the people in them. And I'll just give you just a couple of examples. Community leaders in Vermont recently noted that more than 20 sources of capital were needed to fund a housing development project that responded to community needs. And that large number may sound surprising, but it was the only way to make that particular project feasible. I also learned about a community hospital in New Hampshire that was struggling to retain a new doctor that they had just hired because that doctor was unable to find housing for his family. And I actually hear housing-related anecdotes like that frequently. They're pervasive, and I hear about them when I ask people very broad questions about what they see as the challenges and opportunities in their local economy. Housing challenges are often the first thing that I hear about. So indeed, across New England, the housing affordability crisis has expanded well beyond high-growth urban centers like Boston, and now does affect suburban and rural communities in very challenging ways. The Federal Reserve aims to support economic vibrancy across the wide range of communities in all of our regions. And again, our vision is a vibrant economy that works for everybody, not just for some people. And we do that particularly by advancing data-driven insights and analysis. And one way to do that is by helping participants in the economy access and apply data effectively. And like the Joint Center, we see this as an important contribution to help inform decision-making. Fed experts continue to develop housing-relevant data and analytic techniques, often collaborating with academic and policy researchers. And I think seeing us all come together here is just a reminder of how powerful some of those collaborations really can continue to be. Fed researchers have tackled data gaps in overlooked housing markets, for example. And one example there relates to land lease manufactured housing communities, what many people call mobile home parks. These communities provide affordable home ownership for modest income households. But while the residents own their homes, someone else owns the land underneath those homes, creating vulnerabilities. And work by the Philadelphia Fed to identify such communities enabled the Pennsylvania Housing Finance Agency to support conversions to resident home ownership of the land beneath people's homes, increasing residential security. Indeed, data and analytics are important ways that the Federal Reserve can contribute to the conversation about housing markets. The reserve banks can also assist as nonpartisan, constructive sources for convening and helping leaders connect, collaborate, and innovate. And we know that local cross-sector engagement and collaboration is really key to progress. To give another example, I'll cite a recent undertaking in Vermont's White River Valley. As part of a Boston Fed community development initiative called Working Communities, local leaders there are now helping residents benefit from new state legislation that makes it easier to build accessory dwelling units, or ADUs, which are additional dwellings that share a lot with a primary home. Many residents were not sure how to take advantage of that new policy, and the local Working Communities participants stepped in to help guide homeowners through that process, expanding housing supply and ultimately helping families to build wealth. And so I've given just a few examples of the range of work that reserve banks can assist with and can encourage at the local and regional level, again, leveraging data, leveraging analytics, in light of the housing challenges which persist nationally and which deeply affect local outcomes. Later in the program, you'll hear about the Federal Reserve's system-wide effort to elevate the housing work that is happening across many reserve banks. So I'll conclude by highlighting that individuals, families, and communities are profoundly affected by challenges with access to housing that they can afford. It's clear that no single institution or sector can solve the many challenges by itself that we're going to hear about today, and that recognizing that the current crisis developed over many decades means that this will take time and persistence. These issues are both urgent and important, and addressing them will require continued creative thinking and collaboration across the public and private sectors, as well as among practitioners, researchers, and community leaders. It's going to take all of us working together. So thank you for bringing all of your expertise, but also your commitment to this critical, difficult, I'll call constellation of issues. And now I really look forward to hearing from Daniel McHugh of the Joint Center on Housing Studies about the report, and then to a very informative, and I'm sure it will be an engaging set of discussions as we continue this really important work. So again, thank you for joining us, and delighted to turn things over to David.
Well, thank you, Dr. Collins. Hello and welcome again. My name is Daniel McHugh. I'm a senior researcher at the Joint Center for Housing Studies, and I head up our work on the State of the Nation's Housing Report. And as such, I'm happy to share with you findings from this year's report in a brief presentation, just to tee up some issues for the conversation we'll be having in just a few minutes. Like so many areas, housing is awash in uncertainty. So today, what I'd like to focus on is what we do know based on this year's report. So I'm focusing on three major findings from this year's report. First, that high housing costs are a challenge to homebuyers and a burden to homeowners. Second, that high costs are also a challenge for renters, and it's soon to be a greater challenge given that markets are tightening. And lastly, for the lowest income households, given these conditions and others that we'll talk about, the need for housing assistance has never been higher. So let me show you what I'm talking about. We'll start with the for sale side, where affordability is a key challenge and it's a significant barrier to home ownership. To begin, home prices are high and still rising. Prices were up another 4% over the past year nationally, which puts them up fully 60% since 2019. So let me say that again. Home prices are up 60% in just the past 5 years. That makes them expensive. The median U.S. home price broke the $400,000 barrier for the first time ever last year, putting it 5 times median household income. This is as high a ratio as was during the boom in 2005, and well above the standard 3 times ratio that held during the 1990s. In fact, very few metropolitan areas have priced income ratios within that old standard limit of 3 that used to indicate affordability. Just 3 out of the top 100 metros met this criteria in 2024, compared to 75 back in 1990. But it's not just home prices, but interest rates that impact homebuyer costs, and interest rates remain high. Monthly mortgage payments on the median-priced home increased another $90 last year to over $2,600 a month. It's $1,100 a month higher than in 2021, and the highest mortgage costs, inflation-adjusted mortgage costs, in over 30 years of data. To afford such a payment, a potential homebuyer would need to make over $126,000 a year in order to afford these payments. And as we see on the map, affordability problems span nationwide. In over half of all metropolitan areas, it takes over $100,000 a year to afford the median-priced home. With the cost of home buying so high, understandably, growth in homeowner households is grinding to a halt. After growing by an average of more than 1.5 million per year over the past 5 years, growth in the number of homeowner households was cut in half in 2024 and has dropped even further in early 2025. As a result, homeownership rates fell in 2024 for the first time in 8 years, and the slowing extended to home sales in general, as existing home sales hit their lowest point since 1995, so lowest point in 30 years as well for home sales. One sector bucked this trend, however, over the last year, and that was new home sales. As existing home sales hit new lows, new home sales were able to claw back some gains, rising 3% in 2024, but the increases were hard-fought due to concerted efforts to improve affordability for households on the margins. A combination of smaller homes, lower prices, and financial incentives were offered to bring in buyers on the margins and increase sales. But these gains, based on marginal improvements to affordability, are at risk of being upended by increased costs due to tariffs, which are estimated to raise new home prices by almost $11,000 per unit. So this could make additional gains more difficult to achieve in the future. So while a barrier to home buyers, high costs are also a burden to current homeowners as well, particularly property taxes and insurance costs, which are generally modest relative to monthly mortgage costs, but they're rising quickly. And they can add hundreds to monthly homeowner costs in high-cost areas or high-risk areas. Here we see in Miami, where insurance premium rates are 3 times the national average. Insurance costs would add an estimated $900 per month to costs of the median-priced home. In Boston, where prices are relatively high, the combination of taxes and insurance costs would add on about $1,000 a month on top of principal and interest costs to the median-priced home. These costs rise even for those with fixed mortgages. So they therefore pose a significant burden to homeowners, especially long-term homeowners and those with lower incomes. Here's a chart of cost burdens, which we heard earlier is paying more than the recommended 30% of income on housing. We see that lower income households have the highest rates of burden on record, and they're rising sharply. The stress is starting to show up in mortgage delinquency rates. They remain low overall, the delinquency rates, but they're starting to creep up for FHA and VA loans, which are most likely to go to lower income borrowers. So just another sign of the rising stress on lower income homeowners. So time for a quick recap of where we've been on the for sale side. Home prices at record highs, both overall and relative to incomes. With interest rates still elevated, real monthly mortgage payments are at a record high. Last year we had the lowest, or the fewest existing home sales in 30 years, and the homeownership declined, or the homeownership rate, declined for the first time in 8 years. Oops. Additionally, the gains in new home sales brought about by increased efforts to improve affordability are at risk due to increased costs, and property taxes and insurance costs are lifting cost burdens for lower income homeowners to record levels. Switching to rental markets, high costs are also a challenge for renters, and it's a challenge that may grow as markets begin to tighten as the recent surge in construction ends. That surge in construction has given renters a bit of a reprieve over the past couple of years as rent growth stalled, but only after having risen 30% in the early 2020s, a rise that left lower income renters struggling with housing costs. The softening of rents varied by market, depending on how much construction occurred. Markets with the biggest increases in multifamily construction, mainly in the West and the South, saw the most slowing of rent growth, see here in the blues. Meanwhile, markets in the Northeast and Midwest continued to see modest rates of growth in rents. The surge in construction that's been holding down rent growth, however, is over. While completions are still high, multifamily starts have fallen by double digits for the second year in a row in 2024. Meanwhile, renter household growth in the number of renter households, is accelerating due to the high barriers of home ownership, keeping more older, higher income households renting. Here we see renter household growth doubled in 2024, and the pace quickened in early 2025. The result is that apartment markets are starting to tighten. Here in this dark line, we see how the number of new apartment renters added over the past year grew to surpass the number of new units added, even during the surge in new units. As a result, vacancy rates are falling and rents are starting to rise. This is a concern because renter cost burdens are still at record highs. And the biggest affordability squeeze from this additional tightening will be for the lowest income renters. Nearly 1 in 3 renters makes less than $30,000 per year. And we see here that more than 80% of renters in this group are cost burdened. And 2/3 of renters in this group are severely cost burdened by paying more than half their incomes on rent. The report details just how tight budgets are for these renters. After paying for rent, these lower income renters, you'll see in the report, have just an average of $250 left over each month to pay for all other necessities. So that's $250 to pay for food, for gas, for everything, let alone, savings. So that puts these households in a very precarious financial situation. And it's one example of how needs are growing greater than ever. Assistance levels can't keep up with the growing need for affordable rental units. Only 1 out of every 4 very low-income renters who qualify for assistance get it. And the growth in very low-income renters is happening 3 times the rate as that of assistance. So as a result, at last measure, we have a record high 8.5 million low-income renters facing severe housing problems, which we see in this the darkest orange here on this chart. And most of those receiving assistance, about 2/3 of them, are not in the labor force. They're being of retirement age or with a disability, meaning that there's very little assistance available to help the millions of working families living paycheck to paycheck to make ends meet. And with assistance reaching so few of those in need, homelessness is surging. Homelessness is up 18% over the past year and 33% since 2020, totaling over 750,000 people. Chronic homelessness is also at record highs, having nearly doubled since 2016. And the challenges to housing extend beyond affordability as climate-related disasters are growing, more frequent and more costly. This is bringing increased need to prepare and protect the stock from the increased risk and increased funds needed to recover when disaster strikes. There's other types of needs as well. Looking forward, an additional challenge on the horizon includes that of adapting the stock to meet the needs of an aging population. The number of householders age 80 and over is projected to double in the next 20 years, adding nearly 10 million households to this oldest age group. This will bring increased needs and increased urgency to adapt the housing stock to meet the needs of this population with things like accessibility improvements, at-home services, and even the more mundane costs of simple upkeep, given that so many of these households are low income. So time for another recap before I conclude. We've had record high housing cost burdens for renters and low-income homeowners, record high numbers experiencing homelessness and chronic homelessness. We have a record high rate of billion-dollar climate and weather-related disasters. And on the horizon, we see unprecedented growth in the number of older adult householders. It all points to the fact that now is not the time to step back, but to step up efforts to increase affordability, lower housing costs, and address the ever-growing needs of the nation's households. And with that, let me turn it to our panel and Andrew Brinker from the Boston Globe. Okay.
Well, thanks, Dan, for that great summary of this year's findings and for all your work leading the report. We've got as Dan said, I'm Andrew Brinker, housing reporter at the Boston Globe. We've got a great group of Massachusetts panelists for you folks. We'll talk about some local stuff, and we'll broaden it nationally as well. So I just want to introduce them really quickly. So first joining us, we have Massachusetts State Senator Lydia Edwards. We have the managing principal of Civitas Builders, John Barros. We have Clark Ziegler, the executive director of the Massachusetts Housing Partnership, and of course, Chris Herbert, managing director of the Joint Center for Housing Studies. So there's a lot to dig into here. I want to thank you all for being here on this, the hottest day of the year in Boston. Last I saw it was 102 degrees outside, so we're 1 or 2 degrees from the temperature record, which is great. So, Chris, I want to start with you. I think one of the underlying themes in this report is just this sort of increased overall degradation of affordability in the housing market in the United States. There was one particular statistic that really jumped out to me, which is that fully 50% of the renters in the United States are now considered cost burdened, which we would consider somebody cost burdened if they're paying more than 30% of their income towards their housing costs. So I want to talk about what this means for renters a little bit first. Chris, if you can speak to what renters are seeing out there, obviously in a high-cost housing market like Boston, but also nationally.
Great, thank you, Andrew. So, can you hear me? No. Well, how about that? A little better? Great. So I think, between Dr. Collins' remarks and Dan's remarks, I think you got a good picture. So 50% of renters are cost burdened. A record number, 22 million are spending more than 30% of their income. 12 million renters are spending more than half of their income on housing. In the report, we also document what does that mean? And when we talk about after you spend that much for housing, because the rent eats first, how much do you have left over to spend for everything else in your life? And if you look at low-income renters, the amount of money they have left over to spend on everything else has fallen to a ridiculously low level, hundreds of dollars a month or less that they have left over for food, for transportation, for savings. And so what renters are feeling is just the pinch, I guess, in a very significant way. A couple other facts from the report that I think are kind of mind-boggling. If we look at the number of apartments renting for less than $600 a month, which I know I'm in Boston, that seems like a crazy low amount, but for much of the country, that was a rent you could find. It'd be humble housing, simple housing, maybe not the greatest housing, but you could find it. There are 2.5 million fewer of those units than there were in 2013. If you look at units between $600 and $1,000 a month, renting a month, there's 5 million fewer of those since 2013. So 7.5 million fewer rental units for less than $1,000. So what's happening in the market is that it's becoming increasingly hard to find apartments that rent for modest amounts. And so the question then is there any hope that things will get better? And I think that Dan showed is that we actually had a situation where we've been building a lot of apartments. We have over 600,000 apartments came online last year. We were seeing vacancy rates starting to go up. We saw nationally that rent growth slowed to less than 1%. Hallelujah, we have some help on the horizon. But what's happening now is housing markets are linked. And so when we see that it costs $126,000, it takes $126,000 in income to be able to afford a median price house, and only 15% of renters have that much income, let alone the cash you need for a down payment. People can't get into home ownership. So what are they doing? They're renting longer. So suddenly that what seemed like there's some softness in the rental market is not going to last long. So we already saw last year the number of renter households grew by 800,000 or 900,000. In the first quarter of this year, it's north of 1 million. And so that big supply of housing that coming online is going to be absorbed quickly. Vacancy rates have already started to turn, and we expect to see rents going back up. And so we're really at a point where we need more housing, we need more affordable housing, but the market is not really very conducive. And I'm sure we'll hear from John and others later in the panel about what it's like from the development perspective today to try to build housing. But I apologize, this is a dark report, but I think it's important to understand the situation we're in order to be able to think about what do we do about it.
Yeah, well, Chris, you're talking about how the number of renters nationally is growing, and I think we're seeing that trend here in Boston as well, which is obviously a very high-cost market. Senator Edwards, I wanted to ask you, in the vein of renters and sort of what renters are dealing with right now, I wanted to ask you sort of what you're hearing from your constituents. Are they feeling that? Because, we see all these numbers about how affordability is at, an all-time low, and, more and more folks are struggling to pay their rent and that sort of thing. So, Senator Edwards, I'm wondering if you're seeing that sort of reflected in what your constituents are coming to you and sort of telling you.
It's not new. This might be new to, I don't know who it's new to in this room, but the fact that renters are struggling, you didn't need a state senator to come up here to tell you what her constituents are dealing with. I know if I hadn't have bought my house when I was in 2008, when the market crashed in East Boston, and I was able to get an FHA loan for $9,000 as a down payment, I would not be in East Boston, and therefore I wouldn't be a state senator today. So this is not new. The rent has been eating first. Rent ate it all. We are struggling immensely in East Boston. 70% of East Boston were renters before. We've always been a working class, predominantly immigrant-based neighborhood where we were already renter heavy. That was normal. You would start out in East Boston in many cases and then go to the Orient Heights part of East Boston, or you would go into Revere, Danvers, there was a whole migration pattern for a lot of city neighborhoods. And it's just the opposite now. It seems like people are coming from the suburbs and coming into the city and making it even harder for some people to compete. So we have driving forces of students in Suffolk and coming in and renting. They're paying $600 each for the 2 or 3 bedroom, or actually maybe $1,000 each for those bedrooms. So they're paying the affordable rents, but for one unit, and the family can't afford to compete with that. And then you have some folks who have decided that they want to be back in the city, and they want to, they sell their house in the suburbs, and so they're coming back in the city, and they're also competing. And so you have a lot of these competing forces. Throw in a little COVID, throw in an eviction crisis, which is still something we've been under. So this is not new. We are on fire and have been on fire for a long time in Boston.
Yeah. And I want to talk about homeownership a little bit too. So obviously the numbers of renters in the United States, the share of renters in the United States is growing, which sort of naturally leads us to the conclusion that homeownership is falling. And I think there was a finding in the report that the homeownership rate shrank for the first time in 8 years nationally, which is concerning. If you take together mortgage rates and the cost of homes, and all of these things, it doesn't seem like it is more expensive than ever to afford a home in the United States. And Clark, I want to ask you, should we be concerned about the current state of, sort of where these trends are headed, that it feels so much like, maybe buying a home 20 years ago was something that, a working class family could afford or a lower middle class family could afford. And now it sort of feels like, it is becoming something that, depending on where you are in the United States, but certainly somewhere like here in Boston, it's becoming something that feels like it's reserved more for folks that are sort of wealthier and wealthier.
Yeah, I think what's most, I was trying to think of adjectives to describe how I felt reading the report about homeownership. I think what troubles me the most is how national the problem is. I think we're in a higher income, high cost state. I'm used to a narrative, sort of having to apologize for how much local resistance there is to building new housing in Massachusetts and all of our kind of unique challenges. And you sort of think of the rest of the country, the heartland, well, the private sector can build homes and incomes are lower, but people can get by. And so it's sort of, you convince yourself this is a coastal problem, this is a San Francisco problem and a Boston problem. And the data today says something entirely different. There are two other data points that I was looking at that really kind of shaped this for me. One is the Census Bureau's homeownership vacancy rate, which over the last 10 years dropped by about half, from 2% to 1%, which is a very, very low rate, indicating lack of response to housing demand. And that decline started happening before COVID, before rates shot up, before tariffs. So this is something that's been seemingly in the making for a while. And the second data point that hits me, the home builders reported last year that 86% of all the new homes sold last year were detached single-family homes. Only 8% were attached homes like townhouses, only 6% were condos. So, we're really not doing a lot to diversify what's being built, what can be built arguably at lower cost to serve more people. And as a lending organization, what I think about is, I'm sort of appalled at how many millions of home buyers are being knocked out of the market. But what I'm really focused on is what's the price point we can get down to reach more of those people. We know what people make. What are we doing to bring those costs down? And the senator always used a fire analogy. But I was going to say we need our hair on fire around housing costs. We need to be so many of the factors that control what can get built at what cost are state and local. They have to do with big building regulation and zoning and community expectations and on, and all the stuff we're familiar with in a place like Massachusetts. We have to be deadly serious about creating different options, disrupting this industry that honestly has been doing things the same way for decades, if not half a century or longer. We have to find ways to meet people where they are, produce products they can afford, and shake up this system. And I think we're just nowhere close to where we need to be in doing that.
Yeah, well, John, I want to ask you, Clark was talking a little bit about, the sort of homes that we're building and selling right now. I wanted to ask you about sort of the production side of things. So we're in a bit of an interesting time where, we've just had this sort of large sort of glut of apartments come online nationally. I think Chris cited something like 600,000 units or something like that, rental units specifically. But I think we also sort of know that building boom is coming to an end right now, and there's a couple of factors behind that. There's interest rates, there's the cost of building, construction materials are expensive, and then there's the cost of borrowing, which I think is really driving up the cost of building. So I'm curious from your perspective what the outlook is for builders right now.
Don't forget tariffs.
And sure, and tariffs.
Yeah. So, trade. No, that's right. It's the report's dark because it's dark, right? It's tough. There's a lot of headwinds. You heard it right. Cost of land, cost of construction, cost of money. It's all doing this, and incomes are sort of stagnant, right? And then everybody's worried, right? Consumer confidence and builder confidence, and there's a lot of uncertainty. I think the presentation started with an abundance of uncertainty out there, and you can't make investments on uncertainty, on unknowns, right? It's tough. So then the market shifted, and the report showed it to the high-end luxury rental units. That's what got built, right? It was a lot of high-end stuff that got built because there were more margins, there's a little bit more certainty, and you can convince maybe an investor to go in with you on the high-end stuff, right? It had better data, there was more demand on the rental side, et cetera. And so that is not looking as good, right? It's hard to pencil. And frankly, the things that got done were that it had to be almost perfect conditions. Don't have any extraordinary costs, right? I was part of a deal recently. We were going to build 331 units, but it needed an EPA grant. We were kind of humming along. We put in our grant. We told we looked good. And along came government. Trump decided he was going to freeze those grants. Bye-bye project, right? And so it needs to be perfect in order to work even when you had, and that one had a third affordable and a third market. So it looks really bad out there in terms of the outlook. If we think about sort of the cost of money and the cost of land and the cost of construction, it leaves us with a need to sort of do alternative thinking on each one of those sort of buckets, right, to really make this work. And I think that's where we're going to find some relief is sort of, and I can look at the senator here. So Massachusetts putting out the Momentum Fund, right, and alternative capital, right, to make deals work, and not just cheaper capital. It was alternative in how it was being used, right, and sort of that's the kind of thing we're going to need for the outlook to look better.
Gotcha. Okay. Yeah, we're seeing a lot of that in Boston, especially with the cost of land being so high here. Having trouble making those projects work. And I know we're talking a lot about how dark everything is right now, but we'll talk about solutions soon too. Senator Edwards, I wanted to ask you, Dan noted in his sort of presentation that the need for housing assistance is at an all-time high in the United States, and we're certainly seeing that here in Massachusetts. In President Trump's budget that was proposed a couple of months ago, there are some pretty deep cuts outlined to housing assistance funding. I think it was something like fully 40% of all funding for public housing and Section 8 would be cut under this proposal. I am curious sort of what something like that would mean for a place like Massachusetts, or you can speak nationally too, but where we're sort of seeing, we're seeing homelessness hit an all-time high. We're seeing an all-time high need for housing assistance, and the proposal on the table right now is to cut housing assistance.
Yeah, no, in general, if you're a state lawmaker or a city or a municipal lawmaker, there's a certain level of pressure that we have on us by not having a federal partner in all aspects of our lives. That's housing. There were cuts proposed to Medicaid, which would impact 250,000, 250,000 people in Massachusetts if those cuts go through the big, beautiful bill. And there's all of those different aspects that we are feeling as local lawmakers that you are trying your best with the toolkit that you have and the powers that you have, and also the budget that you have, which for decades has always included some form of federal partnership. Some form. May go up, may go down, but never hostile to the concept. It is what it is. You've always had that depending on who's in the White House. But this kind of hostility is new. And so it requires us to think more creatively, not just we need more money. We need to think of also barriers that our laws allow that make it more expensive for people. One of the things I'm very proud of, and I think we're on the cusp of doing, is putting money back into the pockets of renters by eliminating forced broker's fees. Right now, you have to pay first, last security, and we're one of the few markets that allow also a broker's fee.
I think we're now the only market.
We are now. New York got rid of theirs, so we're on the cusp of negotiating that language. And to me, as a policymaker, but also as someone who knows and hears directly from people, I need $12,000 to rent. So this is removing that one last aspect. right? That doesn't cost us anything, and that's completely within our control. Another thing that also is putting money back in people's pockets, and we're waiting on the regulations, we passed this in the bond bill, is we're looking at payments in lieu of a security deposit, where a landlord and tenant can agree, we're getting the regulations, such to an agreement where I don't pay the security deposit as a tenant, but I will pay monthly premiums on an insurance policy that benefits you. Those premiums being $30 a month. So if that goes through and the regulations work out and the tenants and the landlord work that out, we can get rid of broker's fees and we can get rid of the security deposit. And now it's just first and last. So it seems like, no, it's not put immediately hundreds of thousands of units online, but it does put tens of thousands of dollars in people's pockets. And what that means is they're in a better position to try and get out and move and rent in different places. I don't think people understand high rents or those initial costs freeze people. My staff tells me I am frozen. My rent is going up on one end and I can't afford to pay the first, last security and a broker's fee to leave. I'm just going to sit here and suffer. So that's one thing. The other aspect, again, locally controlled housing inspections. There was a great article on it if you want to see that. We've required now that you cannot condition the sale of a home on waiving a home inspection. Now, that does one thing, and for me, it helps prevent the amount of speculative market that's going on. The cash-only buyers who don't need a home inspection probably aren't going to be living in that home. They're probably tearing it down to put in something or do whatever. In East Boston, they ripped us apart. I mean, they ripped us apart and built up homes, and shoddy work, and those homes fell down. We had homeless people based off the fact that they just came through and ripped through our neighborhood during the recession. So, but to speak to home ownership and to speak to the access to home ownership, it slows down so that now someone with a first-time homeowner loan, an FHA loan, a VA loan, any kind of loan, which the bank will require a home inspection, they're now competing in real ways for this house. So these are barriers that aren't dealing with the lack of federal funding, but they are loosening the grip and also forcing us to look at a mirror at what we have done to maintain the system, or if not expand this ridiculous system that's become so expensive. We didn't get here being one of the most expensive markets in the country because of a federal partnership or lack thereof. That's us. We need to own that. Zoning law reforms, we need to own that. ADUs, yes, in my backyard, my colleague Andy Vargas and Senator Brendan Crichton pushing for those that release and remove ways in which we can have housing within our housing. And it's very frustrating politically, the pushback we've gotten on the MBTA 3A law, all of those different things. That has nothing to do with a federal partner. It has nothing to do with the lack of money. It's everything within us. And so we need to, and I'll own this, as policymakers, make this a matter of, do you want to live here or not? And do you want us to be able to afford, do you want your kids to be able to stay here, and make it the hair on fire arguments about just the local policies that we can completely control. So I kind of wanted to answer your question with a little bit of solutions, and also hopefully shed some light that there are some things we can do. And what we can do, we should be exponentially moving it much faster. Yes, we have the housing bond bill, $5.4 billion. It's not enough. It's not enough. It was supposed to spur housing. It was supposed to spur development, and we were hoping it would catch on. When you have a hostile federal government, it was never supposed to replace that. We don't have enough in that bond bill to do that. See what I'm saying? So we have a lot of local things we have to do. I will speak also to developers. I think you guys are on a commission, or developers in general are on a commission. One thing we have been looking at is tax relief for construction materials, especially if there's tariffs that come through. Again, completely within our control, and how we can benefit. I want to add in the sentence for affordable housing only, but still, it's being able to look at those different solutions and deal with a hostile federal government.
Great. Okay. Great. Well, I want to ask one more sort of question about some of the gloomy trends that we're seeing, and then we'll move on to more
just wanna be
solutions-oriented
negative.
stuff. No, I'm trying to split evenly between negative and solutions. So, Clark, I wanted to ask you, another sort of alarming finding in this report is that, we had seen some of the inequalities in homeownership rates, specifically between the black homeownership rate and the white homeownership rate, and then the Hispanic homeownership rate and the white homeownership rate, have been shrinking for a couple of years. And this last year, they stopped shrinking. I believe one of them grew and one of them remained stagnant. I wonder if that's a trend that you can see continuing, as in, are those gaps sort of going to continue? Are they going to start widening again now? Or is there a world in which, we continue back on that trend from a couple of years running where, they start to shrink?
So I'd like to take this opportunity to pivot from the dark portion of the program. And I can speak to Massachusetts, maybe not as much nationally. This is one area that's a huge success story for the Commonwealth, and it really started in this building in 1989. Some of you may know there was a study here at the Fed that documented really widespread racial discrimination in mortgage lending by Boston banks. It was a bombshell. It was front page news in the Globe for days on end. And what came out of that was a meeting of the minds between community organizations, our organization, the banking industry, to do something concrete to deal with a whole system that had really kept borrowers of color out of home ownership or made it needlessly difficult. And here we are now 35 years later with a program that the banks are still committed to, providing discounted 30-year funds to support, more than $5 billion invested, almost 26,000 successful home purchases. And the whole point is that we came together, and this is an evidence-based program that really looked at what the factors were that got in the way, and it looked at, it includes a graduated payment structure, it includes a state-funded loan loss reserve in lieu of mortgage insurance, it includes extensive community-based homebuyer education and post-purchase support, on and on and on. And in recent years in the pandemic with federal ARPA funds, we were able to sort of supercharge that. And more recently with support from Eastern Bank and the Boston Foundation. So we have figured out here in our own little ecosystem how to do some lasting, long-term, successful interventions that address those historical disparities. I have to go negative for just a moment. What has happened just in the last couple of years is the combination of interest rates and home price appreciation. We had a lot of opportunities for decades in gateway cities, places like Lawrence, Worcester, neighborhoods of Boston, where folks armed with this product were able to purchase homes and successfully stay in those homes and get on with their life. Those opportunities to purchase are fewer and fewer between. Is becoming, even in the gateways, even in what have been very marginal neighborhoods in terms of home prices, it's become incredibly difficult. So it circles all the way back to the national conversation and our own conversation locally about housing supply and creating more product. But for that, I think we have really learned how to do things in the state, and I think with some collaboration on producing more supply, more affordable supply, I think we can keep up that success.
So, Andrew, I know you didn't say jump in, but I know you want us to jump in.
Please jump in, yes,
I'm going to
please.
jump in. So, and I know I'm representing production and development, but I just got to say, I'm really actually worried that we're going to go backwards given the lack of regulation and the deregulation that's happening now, right? And sort of, banks aren't being held to the same standards. And in fact, the deregulation, I think, in the bank space is worrisome when you have a market that's, sort of on the development side, people are trying to figure out how to navigate and make money. Well, you make decisions on how to mitigate risk, right? And oftentimes, black and brown folks are on the other side of mitigation of risk. You got lack of oversight. You got people trying to mitigate risk to try to make money. So I'm worried overall, in fact, of, how the market plays out the uncertainty and, decisions around risk mitigation with the lack of oversight. So I think we see the disparity increase in wealth distribution.
Since we're all jumping in now, I think it's important to recognize that the issues facing black and brown people in terms of getting access to homeownership are not just, I need a down payment or I need a lower interest rate. You need a whole ecosystem of people to help them prepare for homeownership, to see homeownership as feasible. You need to have trusted organizations that are providing that support. You need to have organizations that are working to provide the supply. Over the last few years, there have been a number of initiatives that were really comprehensive in scope that were looking at this very holistically. And it's maybe not politically correct to say these days, but it's got to be race conscious. It's got to be conscious of the fact that there's been historical barriers and they have to be knitted together. So I think we were learning a lot of things about how to knit together resources and create comprehensive programs. I hope we don't lose those muscles. I think there's a lot of organizations, people in this room, who are still doing that work. So I'm hopeful that won't stop. But I think we need to keep having programs that are conscious of the historical legacies of race and how they impact opportunities. One huge factor, of course, is that when house prices are as high as they are, and when you need $25,000 to put down at the table for a 3% FHA loan, a lot of people go to the bank of mom and dad to help make that. And so I know Clark's organization has some great second mortgage programs to help address that. We need to make sure we lean into those because not a lot of black and brown people, or not enough black and brown people, have the bank of mom and dad.
If I jumping in, so dealing with race consciousness, I want to give a shout out to Dr. James Jennings, also to Governor Healy. We created a statewide Office of Fair Housing. It's the first. And that's the point of the Office of Fair Housing, is to deal with how we're growing, and we see $5.4 billion go out there. What is the point in that going out there if we're going to repeat the same mistakes from the past? And we're not going to be conscious of who is or isn't having access to these funds. We're not going to be conscious of, are we supporting, there's many testings of discrimination tester sites. There's a new trend of appraisal discrimination. I know the Attorney General is working on that. She started a housing division. And dealing with all of these different aspects, it is not enough to just build race blind, because we've never have. Right? Our zoning laws have been completely to the degradation of our civil rights laws, and they have done that and still do that. And we need to have an office, when we're talking about state funds, that is dedicated to looking at that. I'm proud, when I was a city councilor, and John, you were with Mayor Walsh, we passed the nation's first affirmatively furthering fair housing law through zoning, so that you have to consider the race consciousness, the desegregation, the classism, all of those different things, the same way that you would consider the traffic impact, your environmental impact. It is a checklist that you must also consider, and the developers have to go through that exercise if you want your project approved. So those are ways in which you, again, push back on a hostile federal government. You'll hear the narrative, and have heard it, I'm sure. They're getting rid of the AFFH, the Affirmatively Furthering Fair Housing. They're saying they're going to save the suburbs. Finish the sentence from people like me. That is the point of that, and that is a dog whistle. It's not even dog. It's a dog bark of racialized. Again, we're not going to require you, if you use our federal money, and if it ends up with a segregated neighborhood, we're going to be like, oh well, it is what it is. Locally, you can do more. And I just wanted to say that that's literally what we're trying to do at the state, and also cities can also take up that mantle as well.
Apologize, Andrew. Just one other thing. We every time there is a report that comes out and talks about disparities, talks about bad actors in the private sector, it hurts production. It kills production, right? We've got to make sure that people don't feel so bad about development. Right, we've got to make sure that people don't feel so bad about developers, right? And so I sit on a public bank board, and as a board member, we discussed making sure we self-regulate in this deregulated environment to make sure that we are not only doing the right thing, but doing the right business thing, right? To continue to be a good bank. And I think, We need to do more in getting rid of NIMBYism. But part of that is making sure that we're singing the praises of an industry, hopefully, as we remake the industry, that is seen as doing the right thing and not gouging people or not trying to, sort of make money at the cost of communities or other people. I think it's a really important thing for production that we continue to be, to not be on the front page for doing the wrong thing.
Great. I think we've got time for maybe two more. So I want to talk a little bit more about the costs of building. Selfishly, it's something I've been reporting a lot recently. It's quite a vexing problem. It seems like all of the sort of costs are heading in the wrong direction right now with materials and interest rates and borrowing costs and that sort of thing. What can we do about that? I'll pitch this one to the group if anybody has any particularly innovative ideas. Is there something that sticks out that we can help sort of cut into those costs? Because obviously we know when it costs a lot to build housing, those costs are passed on to the people who are buying or renting it.
Go ahead, Clark.
I'd say one thing that this was a focus of the governor's Unlocking Housing Production Commission is offsite construction, which some people call it modulars, different ways people describe it, but to be able to produce more efficiently, more energy efficiently offsite, assemble on site reduces construction time, reduces cost to a degree. It's been embraced more in other parts of the country than in Massachusetts, although that's starting to change. But it requires a friendly environment for folks who want to come and invest in our Commonwealth and take the risk that there will be a pipeline of development. That's just one of many examples of things where we have to affirmatively, as a Commonwealth, say we need to try doing things differently and to support it and to recognize the financial risk and see how much better we can do.
Certainly looking at, and again, Maura Healy's led on this, and that is looking at our state assets and public land and figuring out where we're using it as a massive parking lot next to a commuter rail station. Why aren't we looking at some sort of mixed use development where you can keep the parking lot, deck it even, and build housing above? And so how aren't we thinking of creative ways that reducing the cost so there's no acquisition cost, right? It's just build on top of what we have. Project Mayor Wu is pushing, and I think is finally gone out to bid and is going to happen, is the West End Library. That's going to be a couple hundred units, family-sized, majority affordable, in downtown Boston. To bring families back to downtown Boston, I mean, we have 2 schools in downtown Boston because we don't have kids to go to the public schools. I mean, I'm sure they're going to private schools, but it's to me that's a great example. So the acquisition, 0, but you got to build up and you got to agree to certain affordability rates. So I know that there's put some money in for conversion of office buildings. That is, I think, a lot harder than people had hoped. Throwing money just didn't seem to work. But we are getting some of it done, and I think I hope the first couple buildings we're doing, we'll learn some lessons. We'll learn how to be more efficient. We'll learn how to do it better so that by the time we're really hoping to get a pipeline together, we're able to get the zoning in line, getting all of these things in line. So, and honestly, I want to give credit where credit's due. These are innovative ways in which we're trying to think of doing things. So to a certain extent, I'm asking for patience as well. If we're going to say, hey, we're going out and we're just going to give this land to get this property going or convert these buildings, it's a certain level of patience and understanding we're going to make some mistakes for the greater good, for the lessons, for the industry, hopefully, that we're trying to create.
Let me pick up on that real quickly and say, I think this is an opportunity for greater cross collaboration across sectors, right? And government could use the academy in understanding new policy and then codify it to make it predictable, right? So you're absolutely right. Give government some time to figure it out. But as government's figuring it out, let's document that. Right? So that way it's not always one-off. So that way the development world knows, okay, that's what Mayor Wu wants to see, and she wants it like that. That's what we can go and make work, and that's what the tax break looks like for whatever period of year, et cetera. So I love the fact that government is in this innovation space. Government is trying, like the Momentum Fund, like we're trying to figure out the right terms to make it work, right? And I feel like, just speaking as a former public servant, we're slow, right? And maybe the academy can help us codify and get it out quicker. And then I feel like we also need to do more marketing and for any investor, right? So think about the ADUs. The ADUs only make sense if homeowners understand how it works and homeowners understand what they can get away with or not get away with, because that's how, like, what's breaking the law, what's not breaking, that kind of thing, right? If homeowners really understand it, then ADUs might pick up some steam, right? And so how do you get the word out to any investor, big developer, small investor, homeowner, right? And so they can go. And I want to shout out the report for recognizing that this anti-immigration wave is crippling the construction labor pool, right? That's exactly right. I mean, on the smaller projects, or even the non-union projects particularly, the labor's running away because they're scared to be on the sites, right? And that's a problem. Last one is on the modulars. I think there's an opening right now. Can we set the table and try to capitalize?
Yeah,
Can
I think I actually think we're just about out of time. I just wanted to ask one more quick one. If somebody can answer in 20 to 30 seconds, it's challenging. Is there, out of all this negative stuff that we're talking about, is there something that we can be optimistic about? The direction we're heading, anything?
So I'll just jump in since I missed the last question. I think what we can be optimistic about is reflect on the conversation we just had, which is we are in a situation where we're facing our hair is on fire, our house is on fire, and it's gotten attention across the board from all levels of government, from the private sector on down. And so I think there is a lot of innovation happening. And I think the bill that was passed in Massachusetts, the work that's being done on off-site construction, the MBTA Communities Act that was passed in Massachusetts, all these things are local, but they're happening in places like Montana and Utah as well. And so I think what we're seeing is that this crisis is the mother of invention. And so we're seeing that happening. The other thing that's happened is that this is a problem. As much as you say this problem has been with us for a long time, the problem is now much more severe for, let's call it the middle class, than it was 20 years ago. And so suddenly that's created a whole different politics of this too, which is good and bad. It's good in the sense that now this is a problem that's not just the poor, it's a whole bunch of folks saying, hey, wait, why is housing so expensive? What do we do about it? The bad part of it is that if we lose sight of the fact, we still got to worry about the fact that people are really poor, and they may need more than just modular construction. But I do think we're seeing a lot of invention. I've been involved with something called the Ivy Prize for Housing Innovation, and every year there's 150 organizations, public, private, nonprofit, and they're all trying different things. And I think there's a lot of experimentation happening. Much of the energy right now is state and local, but I think that's the test bed for what's going to happen. And I think that everybody here in this room who's here because you care about housing are going to help advance the ball. So I think even though it's kind of a dark time, there's a time when there's a lot of creativity flourishing, and I'm hopeful that good ideas will come out of that.
Great. Thanks very much. I think that that is all the time we have, but the full report is obviously available on the Joint Center for Housing Studies website. And I think we're going to take a quick 15-minute break here, and then we'll hear from some folks from the Fed. So thanks, everyone.
I'm Eric Belsky. I'm the Director of Division of Consumer and Community Affairs at the Federal Reserve Board in Washington, and it's really a pleasure to be in Boston, which is just a wonderful city and was my home for many, many years. As you heard, I have a connection to the Joint Center for Housing Studies and worked on many, many State of the Nation's housing reports over the year. And I think, you all were here for that presentation. Dan McHugh, I was telling him earlier, my greatest fear was always that Dan would move on to someplace other than the Joint Center for Housing Studies, and I would have been nervous about this for 10 years, but I went to the Federal Reserve, so I was relieved of that particular worry. But he's done an amazing job for years and years as an anchor for the State of the Nation's Housing Report, and great to hear it presented here today. And you can see why all of us who have had any association with the report are so proud. It really is like an annual rite in the housing world. We have an expression in the housing world, which you all are part of, I think, which is once a houser, always a houser. So I consider myself to be an always houser. So the question is, why am I here in front of you today? And this is an area, housing is part of a broader set of activities that the Fed cares about, that I play some part in at the Federal Reserve Board back in Washington. So that's why I'm here. And what you're going to be treated to, I think, next is a panel of a number of people who work in an area that each Federal Reserve Bank has that goes under the broad umbrella of community development. And if you walk into the Federal Reserve Board building in Washington, you'll see the board has 5 primary functions, core functions. The one that most people focus on for the Fed is monetary policy. And obviously, that is a central thing that the Federal Reserve does. The chair was up on the Hill today and will be again tomorrow testifying on the monetary policy report. So it's very central. You heard from President Collins. That's something that she spends a lot of her time on. There are 8 Federal Open Market Committee meetings a year. But the Federal Reserve has a number of other responsibilities. There's responsibilities for supervision and regulation, has responsibility for consumer protection, community development because of the Community Reinvestment Act. So what I'm going to do is just provide some broader framing remarks for the people you're going to hear from at the Federal Reserve in a number of the Federal Reserve banks who work on housing and specifically on affordable housing. And we certainly heard a lot about affordable housing, and it just gets monotonically worse. You may have a moment where the economy is doing particularly well and a slight easing, but the path just seems to inch higher and higher in terms of the proportion of people are spending, when you think about it, half their income on housing. And I remember back in the day, we had this thought that why don't we look at what people spend when they're spending half of their income on housing? In this case, it's really outlays because the income data isn't so good. But half of your outlays go to housing. What do the rest of your outlays go to? And how does it compare to people, the vast majority of whom are spending 20% of their income if they're at a higher income level? And these are people with lower income levels to begin with. And it is truly shocking, and it's really a challenge for the country and for the nation. So I'm here to frame, why does the Federal Reserve care about housing? Why does it care about affordable housing? And it'll rhyme a little bit with and echo some of the comments that you heard earlier. Hey, Clark, it's good to see you, by the way, sitting back there. Thank you for joining this event here at the Federal Reserve. So there are a lot of reasons why the Federal Reserve has a strong interest in housing and analyzing housing markets and their implications, as well as in the financing of affordable housing. So what are these reasons? So let me start with a few of the reasons the Fed closely follows housing markets. And this is an area that we have several economists who spend a large proportion of their time. And it's because of the enormous implications, which President Collins referenced, to the economy and on households. Housing affects both parts of the Federal Reserve's dual mandate, which was given to us by Congress for price stability and for full employment. One reason the Fed cares so much about housing is that housing is, as I think we all know, the largest single expenditure for most households. One of the implications of it being the largest expenditure for most households is it plays a very significant role. Shelter costs play a significant role and have a very heavy weight in our measures of general price inflation. If housing is so important and you're spending so much of your budget on housing, then its direction in terms of the extent to which it's going up or in some cases going back the other direction makes a big difference to how we think about monetary policy, in particular the price stability aim of monetary policy. So there's a lot of people who follow how housing factors into, say, the consumer price index as one example. A second reason why the Fed plays, and by the way, I was saying my remarks will echo some of yours, President Collins, pays such close attention to housing sector is that because so much of housing is financed, and changes in interest rate affect the levels of housing production remodeling, sales, rehabilitation, and borrowing. And so it truly is a very interest rate sensitive sector. And the Federal Reserve has, a limited number of tools that it can use, and we often describe them as blunt tools because they affect everything in the economy at once, and that's level of interest rates. So as rates rise, these activities, of course, tend to fall, and when rates fall, they tend to increase. And therefore, it contributes enormously to economic cycles, and you heard some of the statistics. In normal times, it's a relatively small proportion of housing production is of the gross domestic product, but going into and coming out of recessions, it plays a really outsized role, and therefore, it's not only important to cycles and the transmission, as we would describe it, of monetary policy, but also to our thoughts about maximum employment. So it's really central to both parts of the dual mandate. A third reason also that President Collins mentioned is that housing wealth also affects economic cycles through consumer spending. And we refer to these kinds of things as wealth effects. As people have more wealth, they tend to spend more because they've got more wealth, and they do, even if they're not realizing that wealth, feel freer to spend, and so we do see these wealth effects. And again, therefore, as home prices rise, existing owners experience an increase in wealth, and it can lead them to spend more. With about 2/3 of all households owning homes, as you saw, housing is a large store of household wealth, so it really does make a particularly big difference to how much wealth people have, and more broadly than many other forms of wealth that people can hold. So when house prices rise, it can give a significant lift to overall consumer spending. When prices fall, it can reduce it. And while not a concern at present, under extreme circumstances, unfortunately these don't come around very often, but when they do, housing can also pose financial stability risks. When unemployment rate is high and home prices drop significantly, again, something we haven't seen since the late 2000s, substantial numbers of borrowers can have a hard time making their mortgage payments or selling their homes at prices high enough to pay off their mortgages. That leads to defaults, foreclosures can drive prices down further and result in larger losses to financial institutions. And so, keeping an eye on what's going on in housing markets matters to sort of the day in and day out. And when, you have economies potentially in stress, you really pay attention to housing carefully as well. So I'll end with why the interest in affordable housing that you're going to hear our speakers really focus on today. And that comes from a different part of what the Federal Reserve is responsible for. As I said, responsible for the payment system, responsible for monetary policy, responsible for supervision and regulation of financial institutions, consumer protection, community development. It's a lot. Where does this community development piece come from? And I think, for most of the people in the room, you know it, but I'll just remind people. It really comes from the Community Reinvestment Act, which is a really unique law. It was passed in 1977, and it placed on banks something that was described by Congress as an affirmative obligation to meet the credit needs of all their communities, including low and moderate income communities, subject to safe and sound lending practices. And the Federal Reserve and other banking agencies are tasked under that act to encourage, and that's again the language that was used, affirmative obligation is one part of the language, encourage banks to meet those affirmative obligation and evaluate each bank's performance in doing so. So mortgage financing for home buyers and owners in low and moderate income communities and households is one such credit need. So we're very focused on how banks are meeting those mortgage credit needs in low and moderate income communities and to low and moderate income households. And another is financing for affordable rental housing for households at those income levels. So we're interested in ways in which these credit needs can and are being met, and what it takes to meet them in a safe and sound fashion. Moreover, because housing is such a large share of households' expenditures, the more people spend on housing, as we heard, the less they have to spend on other goods and services. How much housing takes up of people's incomes influences, for example, how much they have left and therefore their ability to cover emergency expenditures or disruptions in income without borrowing. And, to the extent, as you were mentioning, Chris, people really have a hard time, really hard pressed to save given very high housing costs, which is what we see. They're vulnerable to all sorts of other shocks. It really is important to have a savings cushion. A survey that we do in Washington, the Survey of Household Economic Decision Making, probably the most cited statistic from an annual report we do based on that survey is the number of people who could afford an emergency expense of $400 or more without having to borrow or do something other than kind of run up a credit card or cover it with cash. And it's a very significant proportion. And of course, they tend to be people who are spending more on their housing. It can influence whether and how much insurance coverage they have across a range of insurable risks, from medical to auto to more endogenously property and casualty insurance. And you can actually see that non-trivial proportions of people don't even get property insurance. And when you look at why, the predominant reason they give you is it's expensive and it's costly. So the annual State of the Nation's housing reports have not only underscored and enumerated the size of housing affordability challenges, but also the implications of those affordability challenges for household financial health and resilience, which is an interest of everyone. But households' financial health and resilience is an interest of the Federal Reserve because of its impact on the broader economy. So with that, I'm going to turn things over to Prabal Chakrabarty, who is the Community Affairs Officer and Executive Vice President here at the Boston Federal Reserve. And he's also the chair of a committee of the Community Advisor of the Community Affairs Officers across the system, and does a lot to kind of work on the oversight of what's going on with the activities of the Fed. I've known Prabal for decades. I admire all his accomplishments in the First District, which is the Boston District, and his contributions to our understanding of housing and community development, both in the district here, but nationally. And I consider it a real privilege to consider Prabal a friend. He's been very focused on trying to make sure that the community development function here in Boston is working with a very wide range of stakeholders and helping them do what they can to make a difference in their own communities. And as you'll see, we have many talented researchers helping the Federal Reserve and people in their districts understand housing matters of consequence and why it's such an honor and privilege for me to be any part of this enterprise. With that, Prabal.
If I could have the panel join me up here. And as they make their way up, so we've had that terrific panel from the Joint Center for Housing earlier, and we're now moving to the Fed portion of the panel. And we're going to be talking about housing. It's going to have a little bit of a Fed flavor to it. And so Fed flavor means I have to start with a disclaimer, right, which is that any speaker views you hear today during the course of this event are those of their own, and they do not represent or necessarily represent those of the Federal Reserve or any of the Federal Reserve banks that are sponsoring this event. So, but I do want you to listen as they talk about housing, as well about the role of the Fed. So I want you to sort of squint with your ears a little bit to hear about the Fed, not because we want to be talking about what, sort of who we are, taking credit. That's not what the Fed is about. But rather, as you hear about how we're acting, think about how an entity like us, because we can't be in every community, an entity like that can help work collaboratively and what's needed. And maybe it's you or your institution. So I just want you to be squinting and listening for that. You might hear some cool Fed stuff. So a little bit of Fed trivia. This building itself, like the buildings of my colleagues are going to introduce you to, has the reason there's so much security is not to protect me, but rather to protect all the cash that's here. There's about $6 billion, billion with a B, in cash in the basement of this building. And it's just flowing around like the Willy Wonka chocolate factory. They let me lay in it once every 3 months, and I just float in it. It's amazing, absolutely. It's like a spa. So I haven't told you that yet, Susan. Sorry. It's not true. Come on. All right, shredded money. Those of you who've come here before for events, we did have shredded money for a while. So I can't talk, I'm not allowed to talk about the currency. Something might happen. So, yeah. So with that, I wanted to just sort of introduce my panelists and where they're from. And I should say, they're going to say the name of the bank and the city. But as Susan likes to say, we really should be the Federal Reserve Bank of New England rather than the Federal Reserve Bank of Boston. We cover districts, as do all of theirs. So I'll let them change the name of their bank if they want to, otherwise not. I'm going to have you introduce yourselves because that's the way to test the microphone, and we'll start over here with Elizabeth.
I am Elizabeth Kneebone. I'm the Assistant Vice President of Research in our Community Engagement and Analysis function at the San Francisco Federal Reserve, or the Federal Reserve Bank of the 9 Western States.
Good afternoon. I'm Samantha Porter, and I'm a senior advisor in our community development function at the Federal Reserve Bank of Philadelphia, or the Federal Reserve Bank of the Mid-Atlantic.
Good afternoon. My name is Libby Starling. I am a senior community development advisor at the Federal Reserve Bank of Minneapolis, or as we shall henceforth be known, the Federal Reserve Bank of the Bold North.
I like it.
I'm Jared Elwell, Community Development Regional Manager with the Federal Reserve Bank of Richmond, also known as the Federal Reserve Bank of the Southern Mid-Atlantic.
Wonderful, wonderful. So, but huge populations in these districts, by the way. And so you're going to get a flavor for that. But let me start. My first question is actually for you, Elizabeth. And could you just share a bit about community development's connection to housing? We heard a little bit about it, but deepen it a little bit more.
Yes, I think, we heard President Collins and Eric's remarks really set up well how housing matters to the dual mandate and the work of the Fed. I think you can think about the community development function as advancing those goals, but with a specific charge to focus on lower and moderate income communities and how they're experiencing the economy. And it's sort of, how are they being impacted by emerging issues, by economic conditions. And we have 2 main channels that we do that through, our field engagement and outreach and our research. And actually this panel today is a nice mix of those functions across the system. If you think about on the field engagement side, we have staff in all 12 reserve banks and at the board who are tasked with being out in the community. So they're really making deep networks in the communities that we serve to really listen and connect with stakeholders working in and living in low and moderate income communities to understand their experiences of the economy and changing economic conditions. Eric mentioned the Community Reinvestment Act. These staff are also out helping to make connections as we think about opportunities to drive investment into these communities, to increase economic opportunity, to overcome barriers to economic participation. We also have the research side of the house, and that's where I sit. So staff who are really focused on conducting applied research, bringing data and evidence really grounded in the communities that we serve to understand what barriers to economic participation may be there, but also to help surface some of the solutions and strategies that local stakeholders are using to try to overcome some of those challenges, often working with our field team and engagement colleagues to help lift up those solutions and share them, because that's the sort of the benefit of our federated system where we're really deeply grounded in these communities is we may be seeing something in a market or community that we're serving that can really be useful or potentially helpful in other markets that we can share across the district. And we do both of these things on a lot of different issues that intersect with low-income communities and how they may be experiencing the economy. But obviously for today, we're talking about housing. And I think we can all attest to the fact that in the research that we've been doing, in the engagement that we've been doing, especially in the last few years, it has just become such a pressing challenge and priority across the communities that we're serving. We're really seeing that nationally, urban, suburban, rural, coasts, middle of the country. We can really attest to all the things that we were talking about in Dan's presentation and in the prior panel, how much this has risen to just a forefront across the conversations we're having. President Collins mentioned that too in her engagements, what we're hearing. We're hearing that from nonprofit stakeholders, from businesses who are concerned about hiring or the increasing costs that their employees are facing. It's just really bubbling up in so many different ways in the work that we're doing. And it's also so clearly such a multifaceted challenge. And again, we're rooted in different communities and seeing it play out in different ways locally. But it helps to be able to kind of lift up, see those those local issues, but also have that national perspective when we can share across our districts. And I think today, one thing that we can share that, again, we're seeing different facets of this, but a thread that really runs through, I think, all of our work is concerns around housing supply constraints, which I think we're going to dig into more in our conversation today. But just seeing the way that those constraints and concerns around housing supply are bubbling up and really impacting household financial stability and the ability to participate in the economy.
Thank you, Elizabeth. So our next question is going to be a little bit about the importance of listening and engagement. And just a quick story here. Many of you know Boston Children's Hospital, probably the top-rated children's hospital in the country, maybe the world. They have an interesting model. So you're familiar at sort of hospitals, you know, doctors and nurses will go around with rounds and they'll talk about the sort of patient's symptoms, if you will, in the medical terminology. What they do at Boston Children's is when they do these rounds and they sit in the sort of medical desks and things and they're talking about each patient, they will include at Children's the parent of the child in the circle. And they'll use the same medical terminology and they'll go around it as to what everyone's observing. And then the parent will go and the parent will give what they've observed. That's because who else is going to know, right, and observe best what the sort of symptoms are in the case of a child, but the parent. And so they're included. And that's really important because then, right, you have the learning, you have the engagement, but you also have the parent that's getting sort of educated about the medical circumstances and technology and vocabulary. And I think that's really a good analogy, if you will, for some of what the importance of community engagement is in how the Fed does its work. And so I'd love to start with Samantha and then to Jared to talk a bit about what we're hearing as we go and we talk and learn from community, engage them in.
Well, I really like that analogy, and it makes a lot of sense in terms of how our team, I'm one of a small but mighty team spread out across our district. We have hundreds, literally hundreds of in-person one-on-one and virtual meetings with stakeholders throughout the year. Already this year in the first quarter, we've met with over 100 stakeholders in these one-on-one meetings. And that is our opportunity to really, Prabal, to your point, do that listening. The stakeholders that we talk to give us all kinds of insights. And so we decided at the end of last year, mid last year, that we wanted to even go deeper. And a subset of those are in something that we call LMI insights. So LMI meaning low to moderate income communities and insights that we hear from those folks. Housing is just one part of it. And it has really been a driver in us thinking about what we need to elevate in terms of how communities are experiencing the economy and what we need to do in terms of research to understand those issues as well. And so there's a couple of examples of things that we just wouldn't know if we weren't listening to that many stakeholders on a regular basis across our district. One, for example, is related to what this report points out, and that is the impacts of housing on older adults right now. Older folks are seeing the feeling either that they're locked into a housing situation that is too expensive, or it's very difficult and expensive to make those adaptations, or they're finding that there are very few options to move into that help to support their continued independent aging in place. They just don't exist, and they're not affordable when they are. So one partner, this was, a real surprise, shared with us about how many people are now starting to look for alternatives that almost look like renting rooms in other people's homes, as to address being alone in a very large property that it's hard to dispose of or that they can't afford to dispose of, having supports around being able to live independently, maybe the upkeep and the maintenance of the property and the lending, the availability of capital to sort of make those adaptations. There's all kinds of land use concerns around making those adaptations that we hear about those things directly from stakeholders, and interestingly from stakeholders that are looking at it from different vantage points. You might think that only those that are social service providers are the ones that are lifting this up, but in fact we're hearing about it from affordable housing developers. We're hearing about it from people who are thinking about capital and financing these different things. So I would say in that just in that example, what we hope is by having this robust outreach, that's really a part of our listening, squinting with our ears. I like that. We're able to sort of learn about these dynamics. And there's much more that we're learning as well, but I'll leave it there for now.
Terrific. Jared.
I think it's important to highlight how much of a priority housing is now as opposed to where it was maybe 10 or 12 years ago, too. When we landed in a community 10 or 12 years ago, particularly urban communities, and asked the city to list its top 5 lists of priorities, they would have said jobs, workforce, infrastructure, municipal finances, crime and public safety, schools, and housing may or may not have been on that top list of 5. 2017-18, that started to change, and we were seeing housing as the 4th or 5th highest priority on that list. We can't land in an urban community now and have housing be lower than number 2. Housing is near the top of the list, if not the top of the list. And what we're seeing today is that is permeating into not just suburban, but rural communities. 3 weeks ago, I participated in a housing summit in the deepest parts of Southwest Virginia on the Tennessee border. Our colleagues at the Atlanta Fed have created the Home Ownership Affordability Monitor, and that basically measures the ability of a median income household to afford a median priced home. The HUD threshold of 30% of your income in Southwest Virginia in 2006, it spiked to 29% of median income households' income towards housing. Since then, it's fluctuated between 21 and 24% of their income until 2022, when in the Bristol MSA in Southwest Virginia, it went up to 30%. And then in 2023, 36%. And then in 2024, 38%. And this is not an anomaly. This is the norm now. We're seeing this permeate through all types of communities all over the state. And there are all sorts of policies that are now being implemented to address these things, but it's just to highlight how much of a priority housing has become all across the country, all income levels, all types of communities.
Thank you. And we didn't even have, we could have had all the feds up here talking and hearing about this. And I know we didn't have enough chairs for everyone. We've got the New York Fed and David here. We've got Ksenia here from Dallas, and Atlanta had just come up earlier. Earlier we did hear and saw and heard the panel talk about the report and the Joint Centers report, and it is a dark report, right? A lot of the trends, most of the trends, are not positive. They're not universally so, but there's a lot of the trends focus on supply and this issue of supply, or at least have that as a root. And so now I'd like to bring in Libby and Elizabeth here, and have you each talk about some of the research around the supply part of the housing ecosystem. And let me start with you, Libby, and to say a little bit about what you've been doing with your team in Minneapolis, and then I'll turn to Elizabeth.
Thank you, Prabal. So in the conversation, in the presentation we heard from the Joint Center team, we heard a lot about housing supply from the perspective of what's happening in development, how many new housing units are being added, how many are coming online. And certainly in the second panel, again, we heard the presentation, the developer was being one of the 4 people on that panel. But when we think about housing supply, we think it's important to not only see what's being added to the supply, but what's being happening to the existing housing supply. So about a year ago, we did a series of interviews with the multifamily housing industry in the Twin Cities area of Minneapolis and St. Paul. We talked to the owners of for-profit, or as they say, they used to be for-profit housing. We talked to market rate owners and operators. We talked to nonprofit affordable owners to try and get the full range of what the challenges were that they were facing. And we said that the 2025 State of the nation's housing was dark. The overall sentiment of these interviews was extremely dark as we heard people talk about increasing wages that they're paying to property managers, the inability to hire the traditional handyman, the people to repair the units. At a moment when we all know that rents are high, rents are increasing, supply is lacking, we heard about high vacancy rates that many of the owners were experiencing, not because they didn't have people knocking on their door wanting the properties, but because they didn't have the cash flow and the resources needed to turn the units over when a household was moving out because they didn't have the cash flow on hand. In particular, we heard from the nonprofit owners of affordable housing who were saying their rents were not meeting their operating costs, and they were looking at their cash reserves depleting. Year one, when rents don't cover operating costs, it's easy to go into cash reserves. Year two, it's a bit more painful. But by year 3 or 4, there are no cash reserves to go to operating costs. And this is at a moment when a range of operating costs are increasing. We heard about property taxes. Property insurance is an area where premiums are increasing 20, 30, 40% year over year, at the same time that the property insurance deductibles are also increasing. So we heard a concern across the industry that there are many buildings that are one thunderstorm away from having to close. So with the cost of development that we heard about in the previous panels, thinking about how important it is to protect the housing that currently exists. And so this is very much of a challenge that we are trying to track, trying to be aware of, and trying to shed a light on so that we're protecting the housing stock that we have.
Thanks for that. I'll share 2 different threads that we're working on in terms of the supply piece. One on rental, one on homeownership. And just to pick up the thread that Libby was just talking about on the multifamily owner-operator space, this is something that we've heard from our stakeholders too, reaching out with concerns about the headwinds that they're seeing facing a lot of these properties. I think we're hearing a lot of similar sentiments as to what you said about operating costs, the cost of insurance. What we're delving into, and this is active research underway right now, is as I mentioned before, we have 9 states in our district. How is this similar or different across different types of states or markets? We also know there are differences, as Libby was also alluding to, in types of providers. So you have nonprofit, you have for-profit. There are also regionally based, sort of like locally based, that are very concentrated in one market. Those types of operators have a different risk exposure and risk profile than you might see in larger portfolios that may be balanced across different markets or multiple states. So really trying to disentangle the different headwinds that are facing these owner-operators to understand where the exposure might be higher. But also for those not everybody's impacted equally in this space, right? There are some that are navigating these headwinds with a little more success. And I think that's an important part of this inquiry too, is figuring out what is working for those providers. That might be lessons learned that we can share, again, to help people who may be feeling more stress or portfolios feeling more stress sort of navigate these kind of challenging waters. So more to watch in that space, but clearly a really pressing issue that's coming up in a lot of districts and across the country. The other thread around housing supply as it relates to home ownership is some research that we recently released, authored by my colleague Lizzie Matuzzi and some other co-authors who've been working on this issue around just trying to understand, as we heard in the last panel discussion, a lot of what is getting built still, a big chunk of it is single-family detached housing and larger format single-family homes, which are much more expensive and really not attainable to many first-time home buyers, and especially lower and moderate-income home buyers. So part of this research was just detailing the other parts of the stock that do tend to open up pathways or entry points that can be more attainable. So smaller format homes, someone mentioned townhomes, things like also what we tend to call missing middle sometimes, the duplex, triplex. Also different formats of home ownership, like co-ops or land trusts, can also kind of create more pathways. The thing is, there's just not as many of these options as we see in the traditional single-family space. So part of this research was also trying to start to lift up what are some of the solution sets or strategies that different stakeholders are trying to expand those opportunities to create more space potentially for those lower income or first time home buyers. And there's a developer in our district who is doing some really interesting partnerships with cities, like being able to come and work in a city and identify city-owned property that they can use for infill development. They're using off-site construction, which again, another theme that we heard in the last conversation, to then create what they're calling sort of pocket neighborhoods or cottage courts, where you're seeing a lot of smaller format homes delivered at a price point that can make them more affordable and attainable to first-time home buyers and lower-income home buyers, with actually very little public subsidy involved in the mix. And I think it's a really good example of that kind of creative solution that comes from working in the local market, the public-private partnership, also aligning the zoning that needs to happen to provide that base that allows for that sort of development, and then putting sort of interesting approaches together to bring those price point downs and deliver more supply but at a more affordable level. So those are sort of some of the solutions we're also trying to surface and think about in terms of innovations that might be possible.
That's great. I love the range of different things that you talked about. I mean, it's such a large and diverse country. Of course, it wouldn't be a one-size-fits-all or one approach. It never has been, and certainly it won't. I was trying to listen, Joe, when you were talking about sort of how important this issue has come up, and Samantha alluded to this too. Again, in Boston, we're known for the Boston Marathon, right? And so I'm going to move to solutions, but of course, this isn't really a race that we sort of finish running. I was trying to think about where we are on it. So the marathon course itself, interestingly, it's known for Heartbreak Hill, which is the hard part that you get to, but it actually starts on a sort of slight downhill, which is, I guess, the easier part. It hasn't been easy to build the awareness of this issue. But I would say, just given what I've heard here and what we see in the report, there's a lot of awareness in the country, certainly from people who are affected by this, and awareness by employers and a whole range of actors about the need to do something. The question, of course, is how and what's working and what can work. And so now as we think about whatever mile marker we're on, and again, it's always going to be a need, and a need that shifts in different ways. How do we make progress? How do we move forward? How do we make it to the next mile marker faster? Right? How do we get there faster and pick up the pace? So I'm going to start with Samantha, and then go to Jared, and then to Libby. But maybe if you could talk a little bit about what you're seeing in terms of solutions and responses.
Well, first I want to talk a little bit about process. I'm just going to say a few words about this because, you have to have a training plan if you want to get to that 4-minute mile, if you will, for the runners in the room. And one of the ways that we've done that is by, really using the Fed's convening power. And we have this, right now, a solution series that's going on. It's been built by one of my colleagues who also did a housing accelerator series in 2024. And essentially, it's building that table. And in some ways, because we've talked about this issue and how it's coming up across a variety of stakeholder groups, setting the table for those stakeholders to talk to one another about the pathway towards solutions. And so in one of our rural counties, we established that accelerator. We leveraged the data and all of the research that's across our system around the issue. We reflected that back to that community to say, okay, where are you with housing starts? Where are you with your land use policy? Where are you with all of these things? And then said, okay, now let's have that conversation together. And some really unlikely partnerships have formed in that space. And so that's a little bit of, I just want to say about the how. A chamber of commerce is at the same table as a social service provider, who's at the same table with a for-profit developer, who's at the same table with a financial institution, all talking about looking at these data, looking at this research, and understanding, okay, now we need to, get in shape, as it were, so that we can get to solutions a little bit more quickly. Some of the things that we've seen, on the table there is, in one of my colleagues, shouts out to Eileen over there, around manufactured housing and thinking about that as a solution has been something that, people can really talk about. These are the pros and these are the cons, or these are the pathways. Another area in the same community is thinking about, tax credits have been the traditional approach. And what's expiring? How can we think about some financing solutions that maybe are driven by private market solutions to maintain affordability on what's expiring? I don't think that they would have been able to come to those conclusions if it weren't for a table that was set in a way with data and research that allowed them to say, okay, now we really think about what's possible. On the other hand, we are aggregating, if you will. I think Elizabeth pointed that out. Solutions that are from across the country and giving people similarly a table to say, well, how might that work in our district? And one place that we've seen that, to sort of echo some comments in the previous panel, is people who are in sort of mid-tier or gateway type communities continuing to look towards local government sources and thinking about how to leverage that in partnership with private, developers who would be traditionally called for-profit developers. And in one of our sort of suburban communities, also in Pennsylvania, they have really become quite good at positioning themselves outside of the sort of tax credit space with financial institutions to say, like, hey, we are a place where people can get these smaller startup homes. People can get a toehold in home ownership here if you're willing to put money to the table. They've developed a fund, and that's been really successful for us. So I think that the how we get there is as important as some of the solutions that we've been able to see start to emerge to address, this really challenging issue.
Terrific. And there's a resource there that you mentioned, so
Yeah.
that's super important. Jared.
I think all of the Federal Reserve banks have served as that neutral convener and lent their credibility to the issues and the challenges. Our cause in Virginia and in our district have been made a little bit easier by statewide policies that have been enacted. Specifically, in Virginia, there is a statewide policy that a locality that wants to access economic development funding must have a housing plan or strategy in place. That makes our job a lot easier to bring the public, private, nonprofit, and philanthropic sectors together to have these conversations. We have also seen an initiative that's been launched to create a zoning atlas. And the zoning atlas, which has been done in New Hampshire and Connecticut and I think Montana, has been launched in Virginia. And the goal is to basically help folks understand how zoning impacts housing development and housing affordability. And they're doing that by standardizing and visualizing the data, and it will allow folks to compare how these policies are impacting affordability and development across jurisdictions. Ultimately, there is the goal of having a national zoning atlas. But these are just a couple of examples of how the Federal Reserve banks, and specifically Richmond, has been working with those four entities, public, private, nonprofit, and philanthropic sectors, to understand the importance of housing in economic development, but also in the health and vitality of our communities.
So leaning in on the Fed as a neutral convener, a little bit over a year ago, the Minneapolis Fed did a survey of 10 suburban communities in the Twin Cities area and asked them what their processes would look like to build a 211-unit, 5-story apartment building. No conversation about affordability or costs, but just to say, how long would it take you to approve a particular building? What expenses, what fees would you ask the developers to cover on this? How many public hearings, how many public approvals would you need to get this project through to the point where then someone could actually start building it and dealing with the challenges of construction costs? So this is a hypothetical example looking at what the processes are. What surprised me most about the results that came in was that there's one study that said, oh, we could probably approve this in 30 to 60 days. Another said up to 360 days to approve it. We asked the cities, how many parking units would you require? our hypothetical building that we had put together with some developer partners said, oh, 211 units, we would plan to build 277 parking spaces. Some of the cities said, we don't need that many parking. Others, one said, for that 211 unit building, we might require about 500 parking units. And so thinking about what the costs are to build, whether enclosed parking or surface parking. Another piece was looking at the variation in park dedication fees. So some cities said, oh, we would charge $1,500 per unit for park dedication. Another said we would charge $8,000 per unit for a park dedication fee. So in the conversation, going back to Prabal's marathon metaphor of how do we do this work faster, we asked the question of what are the processes that need to be in place in order to accelerate these processes, in order to have fewer costs placed on new development, and to work through this faster. So we held an event having cities and developers in conversation trying to identify what are the opportunities to accelerate this process while still respecting the needs of local government. In particular, as one local community development director said, Flushing is an underappreciated feature. And so we do want to make sure that new development has access to sewer, has access to infrastructure. But at the same time, there are opportunities to accelerate the process to have fewer public hearings, fewer public approvals in order to get the housing that everyone needs through the process faster.
Terrific. And our time has flown by. I've actually gotten to our last question. The question is going to be, what's one thing you're going to be watching closely in 2025 in this area of housing? One thing that you're going to be watching closely in 2025. But I want to make this a little bit harder. Each of you have to do it in one sentence, okay? So just one sentence. Now, here's the rules. Only one period in a sentence. But I will allow semicolons. Yes, semicolons are okay. Colons are not okay, right? So for you grammarians out there, okay, so semicolons okay, colons not okay, only one period, commas are all right. Quotes are okay. I don't know what else there, wingdings maybe, I don't know, what font you're going to use. Okay, so we're going to start with Elizabeth. We're just going to go down the line here. What's one thing you're going to be watching closely this year in 2025?
Given all the economic uncertainty we've been talking about, I think the ability to listen to real-time reflections of how that's impacting our communities is important. And I will be watching how, in particular, multifamily owner-operators are navigating these headwinds in the months to come.
Great job.
I will not do the complicated sentence construction that Elizabeth provided,
okay.
but similarly, watching the innovations for people to gain a toehold into affordable, whether that's rental or home ownership, moving forward.
I am interested in looking at the number of new units that are being permitted this year in 2025, because that influences what will be coming online and available for occupancy in 2026 and 2027.
And I will be looking at how local and state governments across our district and across the state are responding to the impacts of the federal policies, and specifically the preservation of existing affordable housing.
Terrific. Hey, that was great. Really great. So I'm going to be turning it back to Chris Herbert, but just before I do, could you give all my wonderful panelists a round of applause for the work that they're doing and the other Fed partners that are part of this effort that are co-hosting. So with that, Chris.
Well, my job is to put a blessing on today. So I want to thank you all for coming today. I hope you found the information and the discussion to be of value. What I'm reminded by from this conversation is just the complexity of housing. You know, we've touched on a lot of different pieces here, and I think one of the takeaways I had from the panel I was on was Senator Edwards talking about the need for patience. I think that there's a tendency in human nature to want to have simple, clear solutions. And when we're talking about addressing our housing challenges, it's going to be a complex set of solutions that all have to work together. If we think about the conversation we've had, the problem of affordability comes down to a simple matter, income and costs. And we spend a lot of time, because we're housers, talking about those costs. And as Libby talked about, we tend a lot to talk about new construction and the cost of new construction, which are important. And there's a lot of pieces that go into that land, right? So that's the zoning issue. There's the cost of the structure to build it. There's the cost of the financing. And then there's the operating costs. And so the reason why we have to think about this and be patient and think about this in complex ways is you're not going to solve the affordable housing problem by leaning into any one of those. And I would just caution people to say we're focusing a lot to this age we're in on zoning reform. Is that important? Yes. Is that going to solve the problem by itself? No. And so we have to think about this in a very broad and complex way. So be patient, lean into all those different approaches. Think about not just what it costs to build new housing, but what it costs to preserve and operate existing housing, because 99% of the housing units we have are the housing units that exist already, and not just the new units. So I hope you come away from the conversation today with some sense both of that complexity, but also of the fact that there's lots of different solutions that are percolating, and that I think that there's reason to have hope as long as we keep leaning into those solutions and provide fertile ground for them to come to fruition. So with that, let me give some round of thanks. I want to thank Dr. Collins, President Collins, Emily Weiss, and everyone at the Boston Fed, Praval, for helping to make this such a great event. We really appreciate the partnership. I want to thank Andrew Brinker for leading such a great discussion, and also for being such a great reporter. We are lucky to live in the Boston area to have a great local paper and also have great local reporters, and Andrew really brings great work to life. So thank you, Andrew, for your work today and always. I want to thank Eric Belsky for his remarks and his partnership through the years, for helping to bring together why it is the Fed should care about housing, because obviously this is incredibly important for both the economy and the financial well-being of households, for Praval and his colleagues who helped really illuminate what the Fed is doing and the context of which you're working, not just in the finance system, but through all your connections in the community to bring solutions to bear. So thank you all for your work and for your contributions today. I have to thank my Joint Center colleagues, Dan and Alex Herman, who lead the report, James Chakness, who's our event coordinator, Kerry Donahue, who's at home watching online, who does a tremendous amount to make sure that we're producing a good quality report and getting it out into the world. And I want to thank everybody else at the Joint Center, because this really is a team sport and helping to produce and promote the report. I have to give some thanks to the funders, the Policy Advisory Board of the Joint Center, who are the principal funders. There's some 15 organizations inside that cover the report who also provide both input and also support for the report, so thank them. And finally, I just want to close by calling attention to the Joint Center's mission statement and how the State of the Nation Housing Report helps us to fulfill that mission. And our mission is that we strive to improve equitable access to decent, affordable homes in thriving communities. We do this by conducting rigorous research to advance policy and practice, and by bringing together diverse stakeholders to spark new ideas for addressing housing challenges. I hope that today's event has indeed sparked some new ideas or some new connections that help us realize the vision of decent, affordable housing for all. So thank you, everyone. I thank you for joining us online. For those of you who are here in Boston, we have a reception following, so please join us down the hall for that. And if you're here and you're interested in hard copies of the report, they're available outside and also down the hall. So thank you, everyone, and have a good day and stay cool.